Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll take a look at Moderna's new COVID shot and vaccine trial.
Plus, we'll take a look at how one university system is benefiting from AI, crypto, and power.
But first, we move to some news in the media space.
This week, we heard that Warner Brothers Discovery is splitting into two independent companies, Global Networks and Streaming and Studios.
Global Networks will include entertainment, sports, and cable television brands such as CNN, TNT, and TBS, and will hold a 20% stake in Streaming and Studios.
The separation is expected to be completed by mid-2026, allowing each company to pursue deals and investment opportunities on their own.
For more on this and the latest media news, we were joined by Geetha Ranganathan, Bloomberg Intelligence Senior Media Analyst.
We first asked Geetha if she likes Warner's plan and if it's at all surprising and exciting.
We like the plan. This has been many months in the making. So last December, they had actually reorganized the existing business into these two separate units, the TV business and then the streaming and the studio business, kind of eventually paving the way for exactly the announcement. I think the surprising part, and this is a little bit of a pleasant surprise for Warner Brothers Discovery, has really been on the debt side. So as you well know, the linear TV business is challenged, but the bigger problem for WBD has really been a huge amount of debt. And this debt was really as part of the combination of Warner Brothers and Discovery, which happened a few years ago. At that point, the company had over $55 billion in debt. They've paid about $19 billion down, but they still have $35 billion. But what they're doing now as part of this transaction is they have a tender offer out there. They're really kind of looking to streamline the capital structure. So when you have these two new public companies, there's going to be a much more manageable debt load at both of those companies. And I think investors are really reacting positively to that news.
Geetha, when they put the companies together, one of the arguments was to create scale to compete against Netflix and Disney. What happened to that argument?
Yeah, exactly, Paul. Yes, they did create scale as far as the TV networks part of the business was concerned. You have Discovery, which is really the leader when it comes to nonfiction. You have, the Warner Networks and HBO, which is the leader when it comes to fiction and quality dramas and scripted series. And they thought that would do well, but unfortunately, what happened is, and all media companies, as you well know, Paul, have this conundrum because they have the TV business, which brings in a lot of the cash, but is literally a no growth business. In fact, it is in decline. Both advertising as well as affiliate fees are in decline. But then you had the streaming business, which initially kind of had a little bit of trouble because, in that whole game of subscribers and that land grab for subscribers, they actually ended up incurring a huge amount of losses. But there is this whole wave of content cost rationalization. We've seen a turnaround in all of the streaming businesses, and Warner Brothers Discovery actually has kind of led the charge there. So they were actually the first to get profitable in terms of streaming. And so now we're seeing this huge disconnect, or at least they are saying that there is this huge disconnect between the TV networks business and the streaming, the studios business, which should arguably get a much higher multiple. Mm-hmm. And that's kind of the reason for this split. So we're seeing now multiple companies do this actually. So Comcast, which has the NBC division, they're splitting off their cable networks. We had Lionsgate and Starz, where you have Lionsgate as an independent movie studio, Starz as the media networks, and now you have Warner Brothers Discovery. So there's this whole big movement now towards, this vertical kind of separation, if you will.
I mean, do they all come together then and create kind of one less great TV network thing?
Yeah, that's kind of the plan. So the most logical combination, and this has been floated around for months now, is that with this news of the Comcast, the NBC cable network separation, would that become like this kind of roll-up vehicle? And that's kind of what a lot of the industry experts are thinking, they're expecting now that you have this news with Warner Brothers Discovery, everybody's kind of expecting down the road some combination of maybe that Warner Brothers Discovery TV assets along with the Comcast assets, and who knows who else kind of spins off their networks, and then that becomes this giant kind of TV network umbrella. Going back to Paul's point about scale, because scale really matters now in this business.
All right, how about Paramount, your other sick child in your coverage? What's going on there?
Yeah, so we really don't know what's going on there. So there's been a lot of ups and downs, Paul, with the whole closing of the deal. So the Paramount Skydance transaction, it was announced last year, sometime in July. It was supposed to close by the end of the first half of 2025. But there's just been so many different press reports. They've had to do different things to appease the current administration, to appease President Trump. I'm not sure he is yielding so easily. So it's still kind of 50-50, Paul, whether that transaction actually closes. So there's just too many things up in the air. And then again, there is the lingering question, because we know that Skydance was really only interested in the Paramount studio business. So again, what they kind of do with the TV networks business, what they do with the streaming business, that's all a huge question mark. So visibility very, very limited right now for Paramount.
I guess I just wonder, if you stick all the cable networks together, how does that actually generate real income? I mean, I know that's a cash cow to some extent, right? But then you have a lot of debt and there's no growth. So, like, what kind of asset is that?
Yeah, it's definitely a melting ice cube kind of an asset, which is exactly what, the TV networks have been. The argument that all of these media companies are making, Alex, is that somehow by kind of banding together, because each one of them will have one or two networks that is kind of a must-have network. So if you're looking at Warner, you have CNN. If you're looking at if you're looking at the NBC networks, you have USA, you have MSNBC. So there are definitely always going to be some must-have networks in each portfolio. And kind of putting them all together will stem that rate of decline, or at least that is the argument that they're making. But again, we've seen that cord cutting has actually been far worse than what was initially projected. So again, it remains to be seen. But the idea is they want to milk it till it kind of runs dry.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence Senior Media Analyst.
We move to some news at the world's largest retailer, Walmart.
This week we heard that Walmart's credit cards will once again be issued by the consumer financing company Synchrony Financial. Synchrony previously issued Walmart credit cards for nearly 2 decades until 2018.
Walmart will now use its fintech startup OnePay to partner with Synchrony, and they'll offer co-branded and private label cards in the U.S. later this year.
This comes as Walmart makes a renewed push into financial services. And for more, we were joined by Ben Elliott, Bloomberg Intelligence Consumer Finance Analyst.
We first asked Ben for some background on Synchrony, which initially lost a partnership with Walmart to Capital One.
Yeah, so they had it for about 20 years, right up until 2018, when the renewal sort of negotiations between the two companies got contentious. Walmart was demanding too much for Synchrony, and so Synchrony sort of backed out. And at the time, it was a really big deal, and so this is an equally large deal that they're coming back.
Why did it go away?
So the way Synchrony works is they have these large partners, right? The top 5 partners are more than 50% of their net interest and fees. And what they do is they share the economics with the partner programs in something called a retailer share arrangement. So every couple of years, the partnerships are up for renewal, and Walmart is a gigantic corporation. They have huge leverage, and they were demanding essentially more of the economics than Synchrony could provide and still be profitable.
Ben, talk to us about these kind of branded credit cards, if you will. I mean, my daughter is a master at managing points and doing all that kind of stuff.
It's like a full-time job.
It is, but it pays off every time she's traveling somewhere. It's on points. Talk to us about that, the business of those kinds of cards and kind of the economics.
Yeah, so Synchrony is not so much in that business. They're in the business of providing a credit option, usually to sort of a lower creditworthiness, lower income borrower that is really focused on a single retail partner. So this partnership is going to be, there's going to be 2 cards. One's a general purpose card that kind of does what you're talking about, but the rewards sort of value proposition will typically be a little bit lower. The card will be more accessible. And then the other card will be just used at Walmart. And details are still pretty light on what the reward structure might look like, but the goal is to drive throughput at Walmart and not necessarily at sort of other retailers.
So they also have cards with like JCPenney, Lowe's, Amazon, PayPal, for example. And you mentioned sort of a different type of band of consumer. How is that band of consumer doing?
So Synchrony likes to say that they're managing, they're not thriving, and they're not struggling. This is it's sort of like a subset of wallet share, right? So this is the Synchrony is just seeing how these consumers are behaving at a single retailer for the most part, but there's not a lot of stress. But if you look back at 2018 when they first decided not to renew the Walmart partnership, it's kind of overnight, their charge-offs went down like 60, 70 basis points. So presumably this particular customer set is charging off a little bit higher, like maybe 1 percentage point higher than your typical borrower. So there's going to be, it's an interesting time for Synchrony to go out and look for these sort of more marginal buyers, basically to get growth.
Ben, your coverage of consumer finance companies, you get a good view, those companies get a good view of how the consumer is doing, how they're spending their money. What are you hearing from these companies these days?
So if you look across spending categories, everything is still typically growing a couple percentage points above GDP. There's one obvious standout, which is travel, which is basically people cutting back on their most incremental spend. But if you kind of think about travel, right, you're booking your flights a couple months, maybe a year in advance, and growth in that category is down double digits. So if you kind of extrapolate that forward, will we see a similar shrinking in hotel spending, entertainment, leisure, things like that? Could be a little bit of a canary in the coal mine.
What is Synchrony's flexibility when they're managing, when they're saying that their consumer isn't thriving and they're not dropping off, but they're managing? What does that translate for Synchrony?
Well, so this goes back to what we talked about, the retailer share arrangements. So you share both the profits and you share the costs, right? So, if charge-offs were to rise, the retailer, in this case Walmart, is going to pick up some of those charge-offs. So that kind of softens the blow a little bit for Synchrony as an issuer. But they have other sort of tools in their toolbox. One big one was the late fee, which CFPB had been trying to cap at $8 instead of about $30. But they can use those things like that to incentivize borrowers to pay even when it gets to be more painful.
Ben, are your consumer finance companies, are they talking about credit quality concerns at this point yet?
Credit quality is still great. For companies like Amex, it's pristine, unimpeachable. But the thing to look at is delinquency, just the mechanics, the way charge-offs work. First, you have to go delinquent before you stop paying. And we're not really seeing any sort of increase beyond kind of like seasonal trends in delinquency.
Our thanks to Ben Elliott, Bloomberg Intelligence Consumer Finance Analyst.
Coming up, we're going to break down the White House's plans for nuclear energy.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to the biotech space. This week, we are joined by Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceutical Analyst.
He joined to discuss the latest in the biotech space, from Moderna's recent COVID vaccine approval and placebo trial to new obesity drugs from the biotech company Metsera.
We first began with the money side of things and asked Sam for his take on why more biotech companies are returning cash back to their shareholders.
So I think companies are coming to a realization that they can't just sit on a large pile of cash. The latest one that just happened was $700 million in the bank, and the assets weren't particularly going in the direction that I think shareholders were happy with, which is why the company was sitting at a negative enterprise value of like 100 million or 90 million, depending on when you're looking at it. And I think they thought, well, no, actually 288 million, sorry. They thought it's time to return some of that cash to shareholders, and you're seeing more of this happening. Investors got tired of companies essentially constantly saying, we'll find better things to do with your cash. And the investors go, we know what to do with our cash.
That is like a really weird thing for a biotech company, right? Because isn't the whole value proposition eventually is that you spend all this money on R&D to make that super cool thing that's going to make $1 billion?
Right, sure, Alex. But if you start off saying, I am the expert in this area, and I'm going to take this expertise and translate this idea into a product, and that doesn't work out, then you say, actually, I have another idea that wasn't necessarily your expertise. That's where investors get a little bit edgy. Yeah.
So, Sam, I know the FDA recently approved Moderna's new COVID vaccine. What's new about it, and is it better?
Well, actually, they did a real trial of comparing this new version, I'll tell you what's new about it, with the standard vaccine, Spikevax, that we've been getting. I don't even know how to pronounce the new name. Mnexvia, something like that.
Sure.
I could never. It's not an easy rolling off the tongue. What they've done is that they've taken the dose from 50 micrograms to 10 micrograms. And what that does is that it gives you less reactions. And in fact, in this particular trial, they showed even higher antibody responses compared to the old one. So there is a small possibility. It was only a few 10% or so higher. A small possibility you get a much better efficacy in a real world setting, but it seemed to go in that direction here. So, and that now is going to become the base of all their vaccines going forward.
Right, but that's a good news if you take the vaccine, but then you're not allowed to get the vaccine unless you have underlying comorbidities, right?
Yeah, Alex, it's only you who's not allowed to get the vaccine.
I know, like the one person who COVID loves the most.
You don't have a whole bunch of the qualifying factors. You're not old. You're over 64.
No.
You're not a comorbidity, except the one thing you have, which is something that doesn't show up in these conversations, is a risk of a really bad reaction to COVID, right?
Yes.
Which is something that you've experienced. So what is going on, though, is that the company has, Moderna specifically, has committed to the FDA to do a placebo-controlled trial in a 50 to 64-year or 65-year group of individuals without comorbidities compared to a placebo, i.e. nothing. So that will be where they will have to do this trial. And by committing to it, this trial needs to be large in order to show a difference. And remember, a whole bunch of people are going into these trials now with previous immunity, which means the difference is going to be smaller, which means you're going to need larger trials. So I hope it works out, and I hope the cost isn't punitive for Moderna.
New obesity data from a newish biotech, Metsera, and their obesity issue. What's going on there? What do they have for the market?
Yeah, so they've got a new mechanism, which they're not the only people following it. Lilly's doing it, Novo's doing it, Zealand, and now in partnership with Roche are doing it. And it's targeting not GLP-1s, but amylin in the same sort of pathway of hormones that regulate hunger and satiety, etc., but slightly different. And the theory is that you're going to get a drug that is less difficult to tolerate, i.e. nausea and vomiting is the biggest one with these drugs because they impact the gut. And so here they've presented data that shows pretty good weight loss at a 36-week readout, 36-day readout, 5 weeks. And you've got, unfortunately, 100% nausea rates, but they are at the very low grade, i.e. just feeling a little, I'm assuming, yuck. And then what you've got is that it only seems to, majority of them seem to pass after the first week. So I think this is good.
Our thanks to Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst.
We move next to the energy sector, specifically nuclear energy. Recently, the White House announced its goal to quadruple U.S. nuclear generation capacity by 2050.
The goal is to have reliable energy supply to meet the growing demand for artificial intelligence.
For more, we are joined by Scott Levine, Bloomberg Intelligence Senior Energy and Industrial Services Analyst.
We first asked Scott to explain the complicated relationship with nuclear energy and what the Trump administration would like to do with it.
Nuclear has always kind of been a bit of a strange one for environmentalists and for the industry overall. You know, it's an emissions-free power source, right, which would seem to align well with the goals of environmentalists. However, safety concerns, end up being an issue, 3 Mile Island, Fukushima, and otherwise. And so, with the combination of demand from AI for power of all types, coupled with the fact that it is an emissions-free power source, has really brought it back into the forefront in supporting the AI demand story. So you have the demand picture has clearly strengthened as a result of that. The two things that really blew a hole in the story the last time it was in vogue in the Obama administration was really the shale revolution, which made natural gas so cheap as an alternative. And then in 2011, Fukushima created all kinds of concerns there. So the two really blew a hole in the story then. And now, and 15 years has gone by since then. And the memory has faded. And now it's back in the forefront of folks' minds.
So expanding or keeping alive or recommissioning a nuclear plant is one thing, and that's what we're doing at 3 Mile Island. We're getting it back up and running again. Then Constellation also made that deal with Meta on Monday or Tuesday that it's just continuing to expand. It's going to keep going with its nuclear reactor, right? But building a new one is like a whole different thing. How expensive is that?
Yeah, so we've only built one plant in the last 30 years in this country. It was in Georgia. It was initially expected to cost under $15 billion and take 7.5 years. And it ended up costing over $30 billion to complete. And taking about twice as long as expected. And that was the one that got through, right?
Well, but President Trump and what he outlined in those executive orders is aimed to reduce the time and the money. But can it do it that much?
I mean, in theory, it's possible, yes, but there's so much we don't know, right? I mean, our expectation would be that, we may not even see full-sized reactors built at this point, right? Small modular reactors.
That's where I want to go.
Are being developed.
He said it well. I didn't say it well.
There are, and so these are going to be much more, they're, modular built. They're smaller in terms of the unitization. And so they could be built conceivably behind the grid if the regulators can get comfortable with the safety aspects. So it's conceivable, but none of those have been built yet, right? So a lot of it's still on the come, and a lot of it will depend on the progress of technology, progress of the regulators, et cetera.
Is the technology there? Because we've had people come through here and kind of imply that it is there.
It is on paper. There's
have we built one of them?
We have not built any of them in the U.S. There have been a couple built overseas. Only one design has been approved, and that is NuScale's small modular reactor. And that's basically mimics a light water reactor. It's a smaller version of the plants that are in service now. 2/3 of the ones in service in the U.S. are Westinghouse, 1/3, give or take, are GE, and those are all light water reactors. And then there's a whole other list of companies that are building these more innovative technology, gas-cooled reactors, salt-cooled reactors. None of those are in service, right? And, half of those are in the process of commercialization in some way, shape, or form, but none have been built here. No.
Why is nuclear so interesting to hyperscalers?
Because it's emissions free and because it runs 24/7, right? And that's the big knock on wind and solar, right? And so those two things in and of themselves, they need to be 24/7. They need to be base load in order to support data center needs, number one. And number two, emissions free, supports the environmental mandates of the Metas, the Googles, the Microsofts of the world. And those are two huge positives that can't be ignored. So if indeed we need power for a longer period of time than it's taken to train these models, and all indications suggest that will be the case for inferencing purposes, nuclear's positives are really too great to ignore.
But it's expensive.
Yes.
Who's going to pay for this? Federal government's going to come up with some subsidies? Is the president proposing that?
Yeah, they are proposing that. And that's really kind of the big unknown right now. How much money are they willing to put behind this? When they built the Southern Company plant, Vogtle in Georgia, the Obama administration put over $8 billion in loan guarantees towards that. And it ended up costing $31 to $34 billion. Wow. Yeah. So we're in an age now, right, where the budget's a concern. And some renewable projects are being canceled. Others are being allowed to move forward, whether it's hydrogen, whether it's carbon capture, et cetera. So, Trump's saying he loves nuclear is a big positive there. But how much money they're willing to put behind specific projects is really the key question here.
And that's such an interesting point, because therein lies the problem with hyperscalers. They're not used to taking on that particular kind of risk.
Yeah.
Also, they need power yesterday. So saying that we can get this to you, let's just be generous and say 7 years, let's say 4. They need it yesterday. 4 is not going to be good enough. So are they going to actually help offset the cost for something that won't be available to them in 4 years in an industry like tech that changes really fast?
I mean, every hyperscaler has made positive comments regarding nuclear. Then it comes down to how substantive is that exactly? And so, the reality here is they need interim solutions now to support the growth. They also need longer term solutions. Nuclear certainly could be a longer term solution, but we'll see what the details are. We'll see whether the government's willing to subsidize a portion of those investments. The one thing I can say is utilities are probably going to be reticent to put a lot of money behind this on their own without that backing, given the history of the last 3 decades.
Our thanks to Scott Levine, Bloomberg Intelligence Senior Energy and Industrial Analyst.
Coming up on the program, we're going to break down the state of offshore wind in the U.S.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
This week, we focus on higher education in a story titled Oil-Rich University of Texas Cashes In on AI, Crypto, and Power. You can find it on Bloomberg.com and the terminal.
This story discusses how the University of Texas system is generating cash from new projects on its land from a mix of renewable energy, crypto, and oil and natural gas production.
For more, we are joined by Janet Lorin, Bloomberg Higher Education finance reporter.
We first asked Janet to explain how the University of Texas system is benefiting from AI, crypto, and power.
So the University of Texas system has land 2.1 million acres in the Permian Basin that the state of Texas set aside for higher education in the 1800s, when the land was supposed to be worthless. But then something happened in 1923, struck oil, and for the first 100 years, the University of Texas grew its endowment with oil and gas. And now in the next century, they're looking for revenue from above the surface. They've started with a few wind and solar facilities. They have a crypto mining center, and they're looking to expand to augment their revenue from surface ventures.
So that's so fascinating to me. How quickly are they diversifying? How quickly is the money moving? And I wonder what policy in DC is also sort of filtering down into what the university invests in.
Well, the university actually isn't really investing in anything. They are the landholder, so they're signing lots of leases.
Sure, but they're choosing to then maybe sign it for one part of energy and not another, one might say.
Well, they're looking to find new revenue sources. They've had a few wind and solar facilities on the land, and they just signed a preliminary agreement to lease about 200,000 acres, or 10% of their land, to a company called Apex Clean Energy for wind and solar, and their customers include companies like Meta and the Army and eBay. And right now these things take years and years and years to build. The wind and solar facilities I saw that are up and running for a couple of years, those deals were initially signed several years ago, but it just takes time. And there's new transmission lines that were just approved in Texas, in 3 of them at $10 billion to move power into the Permian. So these wind and solar are producing them, and then these lines will be able to take them.
It's Texas is such an interesting place in the world for many reasons. One of which is when I think of Texas, I think of big oil. The oil rigs and cowboys and all that kind of great stuff. But it's also one of the biggest renewables places.
Yeah.
I mean, they've got a lot of wind, and they got a lot of sun, and they got a lot of land. So How does Texas kind of balance those two things?
Well, they need an all-in approach.
Okay.
And the University of Texas has, really grown its endowment. It's, $48 billion, coming close to Harvard.
Yeah.
And I did a story a couple of years ago about their record year in oil. A few years ago, they got over $2 billion in oil and gas revenue.
That's amazing.
And it's
wonder
just
they could have
cash
these good
into
football
the
teams.
into the endowment.
Can other universities replicate the monetization of their land in a similar way? Like what other universities have this kind of option?
Everybody in Texas knows never sell your mineral rights, but you can't really come close to this. I mean, Rice in Texas, they also have revenue coming from oil, from land, but nothing even comes close to this. University of Oklahoma, I did a story several years ago about, people gift them land, they keep the mineral rights. With fracking, they got, huge increases over time, but, you just can't compare anything to 2 million acres in the Permian Basin. So they are one of the largest, landholders in Texas.
Still, you have a great chart in here that just kind of shows the growth of revenue from their oil and gas business, which is still the vast majority of it. But this surface piece, it sounds like it can be totally incremental.
Yes. And, the head of University Lands, which is the unit of the University of Texas system that runs it, initially he's saying we're kind of looking for a couple of singles here and there, test the waters. And now they're looking for bigger projects where they can have wind and solar power generation, on larger swaths of land to generate more money. Now, keep in mind, under these projects, the wind turbines that I saw, they have oil underneath. And, that business is also working, so it's all concurrent.
All right, I have to ask you this question. Alice can answer it for me. There's a picture here, an operator flaring excess natural gas at a well at UT managed land in Peyote, Texas. So there's gas escaping from the well, and they just kind of light it on fire so it doesn't go into the atmosphere.
Yeah. I mean, in theory, they want to capture it economically, because if you capture it, you can then use it. And also with any sort of environmental restrictions, you got to capture it, but those restrictions are changing, let's say.
And down the road, maybe you can use that natural gas to power a data center.
It's like you got to make it economic. And if you can use it for something else, that's where you got it. Silly question. What are they using all this money for? Like sports teams, like what Paul was just saying?
Good question. So the money from oil and gas goes to basically building things. It's not for operations. So if you look at their campus, and we described in the story a couple of buildings, $50 million for Texas A&M's new business school, tens of millions of dollars for new hospital facilities. They run a bunch of medical schools, different types of technology within those medical schools and those health systems. I forget the number of schools between the two systems, but it's something like 20 plus, MD Anderson Cancer Center.
Yep.
So they build buildings.
Our thanks to Janet Lorin, a Bloomberg Higher Education finance reporter. Each week, we take a look at research from Bloomberg NEF, previously known as New Energy Finance.
They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agricultural sectors.
This week, we looked at BNEF's outlook for offshore wind. For more, we are joined by Oliver Metcalfe, Bloomberg BNEF, head of wind research.
We first asked Oliver to discuss the state of offshore wind in the U.S.
Well, offshore wind projects in the US at the moment are facing a really, really difficult outlook. It's been tough over the last few years. There have been rising costs, supply chain bottlenecks that have hit the sector really hard. High interest rates for such an expensive technology is also something that raises costs a lot. There have been strong political headwinds since the Trump administration took office. So the Trump administration withdrew the permit for that Atlantic Shores project. That was a project that had already faced those higher costs I was talking about, already facing a lot of economic difficulties. And the removal of that permit was the final straw that really pushed the developers over the edge. The project isn't completely cancelled, so Shell and EDF that own that lease area, that kind of marine area, are going to hold on to that lease. There's potential that they could develop that in a different form in the future if there's a more friendly administration to offshore wind. But yeah, a bit of a bleak outlook for the sector at the moment in the US.
What about projects that already are offshore and are already producing? Could those lose their lease and get shut down?
It's not looking like that at the moment. So the Trump administration put a stop work order on a currently under construction project that would feed power into New York called Empire Wind. That's getting developed by the big Norwegian oil major
right?
called Equinor. That one.
Oh, Equinor. This is an Equinor one. Okay.
And Equinor had already invested over a couple of billions of dollars in that project. Thankfully for the sector, the stop work order has been lifted now. That's a good sign for the other projects. There are 5 under construction US offshore wind projects at the moment. So the fact that project was allowed to go ahead is a very, very good signal for other investors that are building projects like Ørsted, like you mentioned, that have projects in the pipeline. So those 5 projects we're expecting to go ahead. All the other ones kind of further out in the pipeline. Federal permitting of projects, federal leasing of new seabed areas to build projects. The kind of development environment has ground to a standstill for those projects that are a little bit further out into the pipeline in US offshore wind.
What's the rest of the world doing with offshore wind these days?
Well, some of those effects that I was talking about that have hit the US have hit other markets around the world. So costs have risen globally. There have been supply chain constraints. There have been high interest rates. That's kind of a global story. But we're seeing a lot of growth despite that around the world for offshore wind. Particularly European countries in the North Sea are building mega projects. We're expecting the largest project in the world to start commissioning their turbines next year. A project called Dogger Bank off the coast of the UK. And then we're just beginning to see markets in Asia start to pick up. So we're beginning to see the globalization of the offshore wind industry. So that's markets like Taiwan, Japan, South Korea, starting to install their first commercial scale projects. And over the next few years, we're expecting them to start installing kind of industrial sized projects that we're already seeing in the North Sea.
You mentioned this earlier, but a couple things that sort of went wrong for offshore wind before the political environment shifted was interest rates. And also supply chain issues. So a lot of, at least the way it was described to me by some of the players, is that they took on a lot of the commodity and supply chain risk, and they didn't properly share that with, say, customers and other developers, and that really hurt them during COVID. Have those two issues, though, sorted themselves out globally?
So there's a couple of different ways that those issues are slowly starting to resolve themselves.
Oh, okay.
So firstly, suppliers are pushing to share a bit more of that risk when they're signing contracts. So things like linking contract price, your final contract price that the customer pays, to a steel price index or a copper price index, for example, to partially protect you from these commodity price movements. Another way that governments are reacting to this kind of things is linking the price of the subsidy you get paid to similar indexes. So linking the price of subsidies to the consumer price index to protect a developer against kind of some of those inflationary impacts. Same goes for commodity prices. So there's a bit of a resolution on the policy side, and then also a bit of a push from supply chain contracts to protect themselves in some of the deals they're signing.
What's the profitability of land-based wind farms versus offshore?
It really depends in the market you're looking at. Typically, the kind of required returns for an investor on an onshore wind farm is lower than an offshore wind farm, where we're kind of more looking kind of 9 plus internal rates of return on a project. Partially that's because the perceived risks of building something onshore are lower than building something offshore. Every time you need to fix a turbine, kind of the whole construction process is just much more difficult when you're doing it on water versus when you're doing it just on land. And also onshore wind projects have been operating. We've been building them for a lot longer. And so just the perceived risks and how we understand those risks, it's much further along for onshore wind farms than offshore wind farms.
All right, thanks to Oliver Metcalfe, Bloomberg BNEF, Head of Wind Research.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.